I was binge watching Succession the other day, and if you haven't seen the series yet, it centers around Logan Roy and four of his children, who essentially fight for control of Logan's company amidst decline in his health. As I kept on watching the series, it got me thinking about how crucial succession planning is for families. Mess it up, and things can get really, really complicated. We all keep hearing such cases here and there, don't we? Now, what if I tell you that there is a framework to plan succession? And not just that, it also comes with numerous tax benefits and can even improve your chances of scoring an IPO allotment. Yes, I'm talking about HUF, or the Hindu Undivided Family. Hello, I'm Vishvajit Sonagara, founder of Quicko, India's leading tax filing platform. In today's video, I'll help you understand everything about HUF. We will cover what is an HUF, the structure of HUF, tax implications on HUF, and lastly, how can you use HUF to plan your finances and save taxes. But before we dive in, hit that subscribe button and notification bell so you never miss out on any of our upcoming videos. Without further ado, let's get started. What is an HUF? Alright. HUF, or Hindu Undivided Family, is a separate legal entity formed by members of a single family. It's like a family club. Can be formed by any Hindu, Jain, Sikh, or Buddhist family in India. Just like you and I, it has its own PAN and bank account. It can earn income, own property, make investments in real estate, gold, shares, and even run a business. One question that arises very often is, why was HUF introduced in the first place? Well, the reason is more emotional than financial. The concept of HUF was introduced in the Hindu law to incentivize families to stick together and ensure proper succession planning. However, these days, HUF is often looked upon as a way to plan and save taxes. Yeah, we'll come to taxes. But before that, let's understand the structure of HUF. First things first, who can form an HUF? See, forming an HUF is quite straightforward. All you need is a family. Picture this. Mr. Sharma, his wife, and their two kids together can form an HUF. And then individuals who lineally descend in that family will automatically become part of Mr. Sharma's HUF. Every HUF essentially has three types of members. Karta. The Karta is generally the eldest male member in the family. In our case, Mr. Sharma. Keep in mind that the assets of HUF are owned by the entire family, and the Karta is just a manager and a decision maker. Co-partner. Co-partners are members who get a share in the properties or assets owned by the HUF by birth. They can demand their share in the HUF and even ask for partition. Quite obviously, the Karta is also one of the co-partners. And lastly, members. Members also have a right in the properties or assets of the HUF. They are entitled to all the benefits from the HUF and its incomes. However, unlike co-partners, they cannot demand partition of the HUF and exercise their right to the assets. Hence, every co-partner is a member of the HUF, but every member not necessarily is a co-partner. For example, Mr. Sharma's wife is a member of the HUF but not a co-partner, while their children are co-partners in the HUF. Remember that any woman married to a co-partner automatically becomes a member of the HUF. Hence, a woman can have rights in two HUFs at any given time. Number one, her father's HUF as a co-partner, and number two, her husband's HUF as a member. But a husband gets no right in his wife's parents' HUF. Now, how long does an HUF continue to exist? Well, it goes on forever until it is dissolved. And at any given point in time, it can add co-partners only up to 4 generations. Let me explain. In the case of Mr. Sharma's HUF, he will be considered the current generation. And the 3 generations after him, his children, his grandchildren, and his great-grandchildren will automatically become co-partners in the HUF. After that, the 5th generation can become only members in the HUF. However, if the current generation of Karta passes away, usually the immediate senior male member of the family becomes the next Karta, and then 4 generations from him are considered. And by the way, if there is no male child, or if the daughter is senior, she can also become the Karta of the HUF after her father. Now you must be wondering, I understood what's an HUF, and different members of an HUF. But what about money? Who owns what and how much in the HUF? See, the assets owned by the HUF are collectively owned by all the members of the HUF. For instance, Mr. Sharma's HUF has assets worth 10 lakh rupees. These assets would be equally divided among Mr. Sharma, his wife, and their 2 children, which means they will each own 1/4 the share in the HUF, which is roughly 2.5 lakh rupees. Now, Mr. Sharma's children will share their inheritance equally with their grandchildren. Therefore, Sharma ji ka beta, along with his 2 children, will collectively own a 1/4 share in the HUF. However, individually, they will each possess 1/12 share in the HUF. It is important to note that daughter-in-laws are not entitled to a direct share in the HUF. Additionally, the husband and children of the daughter do not receive any share in the HUF. Therefore, the share of Sharma ji ki beti will not be further divided with her husband or her children. Hope that was clear. If you're still confused, I would suggest watching this particular section one more time, or just feel free to ask any questions in the comment section below. Okay, let's move ahead and understand the tax implications on an HUF. As I had mentioned earlier, HUF is considered a separate legal entity for tax filing purposes. It has its own tax liabilities and hence you need to file a separate ITR for HUF. HUF is taxed as per the income tax slabs that are followed in cases of individuals like you and I. It can also avail various deductions like individuals. These include basic tax exemption up to income of 2.5 lakh rupees per year, deduction of up to 1.5 lakh under Section 80C against ELSS investments, tax saver FDs, home loan repayments, and life insurance premiums for its members. Deduction on health insurance premiums paid under Section 80D, deductions on donations under Section 80G, exemptions on long-term capital gains of up to 1 lakh from equity investments, exemptions on long-term capital gains under Section 54 and 54F, and many more. Remember that the standard deduction of 50,000 and tax rebate under Section 87A are not applicable for HUFs, since these are only applicable for salaried individuals. Further, an HUF cannot have a PPF account on its name, but it can claim deductions for amounts deposited by the HUF in PPF account for its members. Clear so far? Alright. I know you have been waiting for this and I'm not gonna make you wait any longer. Let's understand how you can use HUF to plan your finances and save taxes. An HUF typically has assets that come from ancestral property, gifts, or capital contributed to the common pool by members of the HUF. And this is where it starts to get really interesting. Let's say you are a family of 4 members. You, your spouse, and 2 children. You and your spouse are both salaried employees and fall in the 30% tax slab. Suppose you have an ancestral property on your name and that generates rental income. Since you fall in the 30% slab, you will have to pay a 30% tax on this rental income. But what if you form an HUF and transfer the property on the HUF's name? If the rental income is less than the basic exemption limit of 2.5 lakh, you would pay 0 taxes on this income. And even if it is above 2.5 lakh, the tax rate would be much lower than it would have been otherwise. Isn't it amazing? Another way people can save taxes with HUF is by opening a Demat account on HUF's name. For example, Mr. Sharma and Mr. Verma are really good friends. Both of them invest the same amount of money in the same stocks. The only difference is that Mr. Sharma invests the entire capital from his personal Demat account, while Mr. Verma invests half his capital from his own account and the other half from his HUF's Demat account. Next year, both of them have long-term capital gains of, let's say, 2 lakh rupees. Now, tax on long-term capital gains from equity is exempt up to 1 lakh. Hence, Mr. Sharma will have to pay 10% tax on remaining 1 lakh, which is about 10,000 rupees. On the other hand, Mr. Verma will pay 0 taxes on his capital gains, since his gains are distributed between 2 Demat accounts and none of them have crossed the 1 lakh basic exemption limit. And this is just one benefit of having a Demat account on your HUF span. Many people also use it to apply for IPOs in order to increase their chances of getting an allotment. Another common scenario is when both husband and wife are salaried employees. They pool their capital and transfer it to the HUF's bank account. This can result in a tax-free interest income of up to 2.5 lakhs because of the basic exemption limit. Further, an HUF can also accept gifts. While gifts received from members are non-taxable, gifts from non-members are taxed as income from other sources if the cumulative value of the gifts received is greater than 50,000 in a particular financial year. If the HUF does not have any income sources, then it can receive a gift of up to 4 lakh without paying a single penny in taxes. Wondering how? Very simple. 2.5 lakh is the basic exemption limit, while the remaining 1.5 lakh can be invested in tax-saving instruments such as ELSS and claimed as a deduction under Section 80C. Finally, the HUF can also come in handy when purchasing a real estate property. For instance, Mr. Sharma decides to buy a new house property. He adds his 2 children and the HUF as co-borrowers in the loan and co-owners in the property. Since the loan is taken jointly, each borrower, including the HUF, can claim the following deductions: home loan interest of up to 2 lakh under Section 24B and principal repayment of up to 1.5 lakh under Section 80C. So you see, just by adding the HUF as a co-borrower, the family can reduce their taxable income by up to 3.5 lakh every year. Now I can go on and on with these examples on how you can use HUF to save taxes, but these were some of the most common ones. If you think we have missed out on any obvious scenarios, do let us know in the comments. Before we conclude, let me give you a reality check. Despite being such a powerful tool of planning and saving taxes, not many folks I know actually form an HUF and avail its benefits. That's because forming an HUF and transferring assets in its name can come with their own complexities and costs. For instance, the registration cost of transferring a property worth 1 crore rupees to the HUF would far outweigh the tax benefits, at least in the short term. Moreover, since all members of the HUF have right to the assets of the HUF, these joint assets cannot be sold without the consent of all members. And as the family grows, so do the opinions. But if HUF is planned well with a long-term perspective, it can be insanely useful for tax planning, as we have discussed in this video. So if you have an ancestral property or multiple income streams, or just want an extra demat for IPO frenzy, HUF might be a good option to consider. And with that, it's a wrap. If you have any questions regarding HUF, suggestions for us and our content, topics you would like us to cover, shoot them in the comment section below. We read each and every comment, so let us know your thoughts there. If you found this video helpful, make sure to hit the like button and subscribe for more tax-related content. Until next time, this is Vishvajit signing off.